What should you own right now? Gold, cash, United States dollars, stocks, or real estate? The honest answer is not one asset. It is a portfolio in which every asset has a specific job. That distinction matters because today's economy is sending conflicting signals. The latest official data shows economic growth slowing to a 1.5% annual rate. Consumer inflation is still 3.4%, above the Federal Reserve's goal. Payroll employment recently fell by 23,000, while unemployment held at 4.1%. The Federal Reserve is keeping its policy rate between 3.5 and 3.75%. Even policymakers disagree about what should happen next. This is not a clean boom, a clean recession, or a clean inflation shock. It is a mixed environment, and mixed environments punish all indecisions. So instead of asking which asset will win, ask 5 better questions. What job must this money perform? When will you need it? How much price movement can you tolerate? Which currency will fund your future spending? And what price are you paying for the asset today? Before applying those filters, check the foundation. Expensive consumer debt can quietly undo the return from a new investment. Paying down a high interest balance may create a more reliable improvement than chasing a market forecast. The goal is not to maximize the number of assets you own. The goal is to strengthen the whole balance sheet. Start with the first filter, the job. Money for an emergency fund has a different job from money for retirement. A house deposit needed next year should not carry the same risk as capital that can remain invested for 10 years. If one pool of money is expected to do every job, the portfolio becomes confused. The second filter is time. Short horizons make liquidity and capital stability more important. Long horizons give productive assets more time to recover from volatility and compound. The third filter is liquidity. An asset can be valuable and still be wrong if you cannot sell it when the bill arrives. The fourth filter is currency. If your future expenses are in dollars, dollar assets can reduce currency mismatch. If your expenses are in another currency, holding dollars creates both protection and exchange rate risk. The fifth filter is price. A good asset bought at an aggressive price can still produce a poor experience. Now apply those 5 filters to cash. Cash is not designed to maximize long-term growth. Its main jobs are liquidity, stability, and optionality. With short treasury bill yields still around the high 3% range, safe liquid money is no longer earning close to zero. That makes cash and short bills useful for emergencies, near-term purchases, and dry powder. But cash has an invisible risk. If inflation runs above the return on your cash, purchasing power still declines. And deposits should be placed with attention to insurance limits and account ownership rules. So cash is a tool, not a permanent answer to every risk. Now consider the United States dollar. The dollar is a currency, not a company and not a productive asset by itself. Holding dollars may help someone who has dollar expenses, dollar debt, or local currency instability. But someone who earns, spends, and invests in another currency is also making an exchange rate bet. If the dollar weakens, the local value of that holding can fall even when the number of dollars is unchanged. Treat currency exposure as a match between assets and future liabilities, not as a permanent prediction that one currency must rise. Next are diversified stocks. Stocks represent ownership in productive businesses. They can grow earnings, reinvest capital, pay dividends, and participate in long-term economic expansion. That makes diversified equities a strong candidate for long-horizon growth money. But stocks are not a substitute for an emergency fund. Prices can fall sharply before the underlying businesses recover. Higher interest rates also raise the discount rate used to value future profits. The current growth picture is slowing, but it is not uniformly weak. That is exactly why a diversified index and a staged buying plan can be more robust than chasing one fashionable stock. The practical question is not whether stocks will rise next week. It is whether you can keep contributing, remain diversified, and avoid selling during a drawdown that your plan should have expected. Now look at gold. Gold has no earnings stream and pays no interest. Its role is usually diversification, purchasing power protection across long periods, and insurance against monetary or geopolitical stress. Institutional demand remains important. Central banks bought about 289 tons in the latest quarter. But gold is already expensive by recent historical standards, and exchange-traded gold funds recorded outflows during that same quarter. Those two facts can be true at once. Strong strategic demand does not prevent corrections. Gold can also struggle when real yields rise or when the dollar strengthens. So gold works better as a measured diversifier than as an emotional all-in trade after a large rally. Then there is real estate. Property can provide shelter, rental income, inflation-linked rents, and exposure to scarce land. It can also use leverage, which magnifies both gains and losses. The average 30-year mortgage rate is around 6.65%. At that financing cost, the purchase price is only the beginning of the calculation. You must include interest, taxes, insurance, maintenance, vacancies, transaction costs, and the time required to sell. A home you plan to occupy for many years is not the same decision as a leveraged rental bought for immediate profit. Real estate becomes attractive only when the use, cash flow, financing, and holding period work together. Now combine the assets through 3 practical cases. Case 1 is money needed within 12 months. The priority is not beating the stock market. The priority is having the money available when the deadline arrives. Insured deposits or short government bills may fit that job better than volatile stocks, gold, or an illiquid property. Case 2 is a 10-year growth plan. Here, a diversified stock core can do the heavy lifting. Cash covers emergencies, while a measured gold position may diversify shocks. The exact mix depends on the investor's risk capacity, currency needs, and ability to continue through drawdowns. Case 3 is a property purchase. The decision should survive a stress test with higher expenses, a vacancy period, and a slower resale. If the numbers only work under perfect conditions, the asset is not providing safety. It is concentrating risk. This leads to one final rule. Do not ask one asset to rescue the entire portfolio. Cash buys time. Dollar exposure manages a currency mismatch. Stocks pursue long-term growth. Gold diversifies monetary and geopolitical stress. Real estate can provide use and income when financing and cash flow are sound. Build a simple worksheet with 3 rows. Money needed this year. Money needed in 3 to 5 years. And money that can remain invested for 10 years or more. For each row, write the required liquidity, acceptable drawdown, spending currency, and the asset's job. Then build a paper portfolio and rebalance it on a fixed schedule instead of reacting to every headline. Rebalancing is important because the asset that rises fastest can silently become the largest risk. Choose a calendar date or a clear allocation band. When the portfolio moves outside that rule, restore the intended balance instead of asking which headline feels most urgent. Also review the plan after a genuine life change, such as a new job, a home purchase, or a change in spending currency. The best asset right now is not the one attracting the loudest prediction. It is the asset that performs the correct job at a risk level and time horizon you can actually maintain. Educational content only, not investment advice.